Look at what SpaceX has built. They completely re-engineered how humanity reaches orbit, and in the process, deployed the largest satellite internet network on Earth. By the time of their public debut in 2026, the market rewarded that engineering dominance with a valuation measured in the trillions of dollars. The consensus is clear. This company is an unstoppable juggernaut. But history tells a very specific story about companies we label unstoppable. Look back at the Nifty 50 stocks of the 1970s, or the internet giants of 1999. Those corporations dominated their industries. They genuinely delivered the technological futures they promised. Yet investors who bought at their peaks spent decades trying to recover their initial capital. The problem was never the quality of those underlying businesses. A world-class company easily becomes a disastrous investment if you simply pay too much for it. Professional investors do not use valuation to predict the future. They use it as a measuring stick. It tells them exactly how much future success is already baked into today's stock price. This chart illustrates the expectation gap we see with SpaceX today. Down here is the $18.7 billion in revenue they generated in 2025. And here is the multi-trillion-dollar valuation that entirely dwarfs it. Buyers at this price are not paying for current earnings. They are paying for a future that is still decades away. To justify this price, Starlink has to monopolize global connectivity. AI initiatives must generate massive profits, and deep space logistics has to become a sprawling, lucrative industry. This creates a structural trap known as the tyranny of perfect expectations. When you price a stock for flawless execution across multiple unproven industries, you leave absolutely zero room for error. This graph shows how that trap springs. Imagine a company is projected to grow revenue by 50%. If it grows by 35%, the business is still highly successful, yet the stock collapses because reality failed the flawless projection. That is the danger of extreme valuations. The company no longer needs to fail for shareholders to lose their money. It merely needs to disappoint. To avoid that trap, we have to look past the speculative future and examine the mechanics of how this company actually makes money right now. The media focuses relentlessly on the dream of colonizing Mars, but the real financial heavy lifting is being done by Starlink. As its subscriber base expands globally, Starlink is generating the bulk of the company's revenue and driving its profitability. It is the financial engine subsidizing the rockets, the AI infrastructure, and the massive ongoing capital investments. Smart investors force themselves to separate the sci-fi headlines from the actual cash flows. The most glamorous project rarely pays the bills. It is usually the unglamorous, predictable segment that funds the grand vision. Decades ago, the foundational investor Benjamin Graham established a simple rule to protect against these scenarios. He taught that every investment requires a margin of safety. You buy a business for less than it is worth, never more. When a stock is trading at a multi-trillion-dollar premium, that margin of safety is completely gone. You are forced to rely on a massive, fragile chain of assumptions. You are betting that management will never make a mistake, competitors will remain scarce, and economic conditions will perfectly cooperate for years. Why do people take that bet? Because they watch early shareholders get immensely wealthy. The fear of missing out takes over, and retail buyers convince themselves that acquiring shares at any price is a smart move. When the fear of missing out completely overrides the margin of safety, you are no longer paying for what exists. You are speculating on what you hope will exist. Professional investors approach this very differently. They do not lead with excitement about the technology. They lead with cold logic and stress test the math. They want to know exactly what assumptions justify the current price tag. They calculate the immense capital required to build out that future, and they map out what happens to the stock if subscriber growth slows even slightly. SpaceX's legacy in aerospace is already cemented. They have achieved things that engineers previously thought impossible. But buying the stock at these peak levels is a massive financial gamble on absolute perfection. This brings us to filter number 7. Before allocating a single dollar, you must explicitly separate the business from the ticker symbol. You have to ask, is this an attractive business or is the valuation attractive? Because in the end, investing comes down to a harsh reality check. How much are you paying for a future that hasn't happened yet? And how certain are you that it will arrive flawlessly?